The investor's chief problem, and even his worst enemy, is likely to be himself. The market does not destroy you. Your own undisciplined mind does. Wealth is not built by the clever. It is built by the patient, the calm, and the psychologically unbreakable. There is a lie you have been living with for years. It sits quietly inside every financial decision you have ever made, every impulsive purchase, every panic sell, every moment you checked your portfolio at 2 in the morning with your heart pounding, and every time you followed a stranger's tip because their confidence made you feel small. The lie is this: you believe that building wealth is about finding the right stock, the right moment, the right secret. You believe the obstacle is knowledge, that if you just knew more, read faster, studied harder, followed the right guru, you would finally crack the code. But that is not your problem. Your problem is not ignorance. Your problem is emotional. Your problem is psychological. Your problem is that you have never been trained to sit still while the world screams at you to move. You have never learned to do nothing when every instinct tells you to act. You have never built the internal architecture required to hold wealth, because wealth does not come to the frantic. It comes to the composed. And right now, in this very moment, you are being invited to confront the most dangerous variable in your entire financial life. Not the market, not inflation, not algorithms. In this audiobook, you will not receive a list of stocks to buy. You will not be handed a formula that guarantees returns. What you will receive is far more valuable. You will undergo an internal transformation. You will learn to think like an intelligent investor, not by memorizing ratios, but by rebuilding the psychological foundation upon which every financial decision you will ever make rests. You will learn the discipline of patience, the power of detachment, the art of seeing value where others see nothing, the strength to hold your position when the crowd runs. And by the end, you will not simply understand investing. You will have become a different person. The kind of person wealth does not flee from. The kind of person the market cannot shake. The kind of person who builds quietly, steadily, and without apology. Let us begin. Chapter 1. The mind that wealth requires. Most people enter the world of investing with a fatal misunderstanding. They believe they are entering a game of numbers. They study charts. They memorize terminology. They download apps and set alerts and watch candles flicker on screens as if some divine pattern will emerge and whisper, "Now, buy now." But what they fail to understand, what almost no one tells them, is that the market is not a math test. It is a psychological arena. It is a mirror, and it reflects back at you every unresolved fear, every undisciplined impulse, every quiet desperation you carry about your future. Benjamin Graham understood this more than 70 years ago. He did not become one of the most respected minds in financial history because he found a magic formula. He became legendary because he understood human nature. He understood that the average person does not lose money because the market is unfair. They lose money because they are emotionally untrained. They buy when they are excited. They sell when they are afraid. They follow crowds because solitude feels dangerous. And they repeat this cycle year after year, wondering why the result never changes. The intelligent investor is not someone with a higher IQ. The intelligent investor is someone with a higher level of emotional sovereignty. They do not react. They respond. They do not predict. They prepare. They do not chase trends. They build positions based on value, and then they wait with a calm that most people cannot comprehend. This is the first and most important lesson you will ever learn about money. Before you invest a single dollar, you must invest in the reconstruction of your own psychology. You must train yourself to be still, to resist the pull of excitement, to endure the discomfort of patience, to find peace in doing nothing when everyone around you is doing something. Because, in the world of investing, the ones who move the least often gain the most, and the ones who move the most often lose everything. Wealth begins not in the market. It begins between your ears. Chapter 2. The illusion of action. You have been conditioned to believe that progress requires movement, that if you are not doing something, you are falling behind. This belief serves you in many areas of life, in your career, in your health, in building relationships. But in investing, this belief is a poison. It is the single most expensive bias a human being can carry into the financial world. Graham called this the trap of speculation disguised as investment. When you feel the compulsion to trade, to adjust, to react to every headline, you are not investing. You are speculating. You are gambling with the costume of sophistication draped over it, and the market is designed to encourage this behavior. Every financial news network, every social media account screaming about the next breakout stock, Every notification on your phone that says a stock just moved 3%, all of it is engineered to make you act. Because when you act, someone profits. But it is rarely you. Consider the investor who checks their portfolio every day. They see a dip and their stomach tightens. They see a rise and a small burst of dopamine fires. Over time, they become addicted not to returns, but to the emotional cycle. The checking becomes compulsive. The decisions become reactive. And slowly, invisibly, they erode the very wealth they were trying to build. Now consider the investor who buys a fundamentally sound asset, sets a long-term horizon, and walks away. They do not check. They do not flinch. They do not care what the market did today because they are not investing for today. They are investing for a decade from now, for 20 years from now, for a future self who will thank them not for their cleverness, but for their restraint. The greatest action you can take as an investor is often inaction. Let that settle. Let it confront every instinct inside you that demands movement. Because the moment you can sit with stillness and not feel like you are failing, you have crossed a threshold that 90% of investors never cross. Stillness is not laziness, it is strategy. Chapter 3, Mr. Market, and the Art of Emotional Immunity. One of the most powerful metaphors in the history of financial thinking came from the mind of Benjamin Graham. He called it Mr. Market, and understanding it will change the way you see not just investing, but your entire relationship with external pressure. Imagine you have a business partner. Every single day, this partner comes to you and offers to buy your share of the business or sell you his share. Some days he is wildly optimistic, offering you a price far above what the business is actually worth. Other days he is in a panic, desperate to sell his share for far less than its true value. He is emotional. He is erratic. He is driven entirely by mood. And here is the critical point. You are under no obligation to trade with him. You can simply say no. You can simply wait. This is the market. Every day, it offers you prices. Some are rational, most are not. The intelligent investor does not let Mr. Market dictate their decisions. They let value dictate their decisions. They observe, they evaluate, and they act only when the price offered is so clearly in their favor that it would be foolish not to. But here is where most people fail. They treat Mr. Market as an authority. When the market drops, they believe the market is telling them something true, that their investment is bad, that they made a mistake, that they need to escape before it gets worse. They personalize the movement. They internalize the panic. And in doing so, they hand over their power to an entity that has no mind, no logic, and no loyalty. The emotionally immune investor sees Mr. Market for what he is: a servant, not a master; an opportunity, not a threat. They use his moods against him. When he is irrationally afraid, they buy. When he is irrationally euphoric, they sell. And in between, they do nothing at all. This is not just financial intelligence. This is psychological mastery. And it extends far beyond investing. The ability to remain unmoved by external emotional noise, to evaluate with clarity while others are drowning in reaction, is a life skill of the highest order. Do not be ruled by the moods of Mr. Market. He is not wise. He is not informed. He is simply loud. And loudness should never be confused with authority. Chapter 4. The margin of safety. There is a concept at the heart of intelligent investing that separates the disciplined from the delusional. It is called the margin of safety. And it is not merely a financial principle. It is a philosophy of life. The margin of safety means this: you never pay full price for anything. You build a buffer between what something is worth and what you pay for it. You assume things will go wrong. You plan for failure, for miscalculation, for surprise. And because you do, when things do go wrong, and they will, you are not destroyed. You are merely inconvenienced. Think about this in terms of your own life. The person who spends everything they earn has no margin of safety. One unexpected expense, one medical bill, one job loss, and they are in freefall. The person who lives below their means, who keeps reserves, who does not stretch every dollar to the edge of its limit, that person can absorb the shocks. That person can survive what others cannot. In investing, the margin of safety means you buy assets when they are priced below their intrinsic value. You do not pay $1 for something worth $1. You pay 70 cents, maybe 60. And that difference, that space between what you paid and what the thing is truly worth, that is your protection. That is your armor. That is the wall between you and ruin. Graham was relentless about this. He did not believe in predicting the future. He did not believe anyone could consistently know what the market would do tomorrow, next month, or next year. But he believed deeply that you could protect yourself from the future by building enough margin into every decision that even if you were wrong, you would survive. And survival, in investing, is everything. because the game rewards those who stay in it the longest. Apply this beyond money. Build margins of safety into your time, into your relationships, into your commitments. Never operate at the edge, because the edge is where you break. Chapter 5. The defensive investor. Graham drew a line between two types of intelligent investors. The first he called the defensive investor. And for most people, this is the most powerful identity they will ever adopt. The defensive investor is not passive out of weakness. They are passive out of wisdom. They understand that they do not have the time, the expertise, or the emotional bandwidth to actively manage a complex portfolio. And rather than pretending otherwise, rather than lying to themselves about their ability to outperform professionals who spend every waking hour immersed in markets, they choose a different path, a quieter path, a more effective one. The defensive investor diversifies broadly. They choose high-quality, established companies or broad index funds that track the overall market. They invest consistently, regardless of what the market is doing. They do not try to time the bottom. They do not try to catch the top. They contribute month after month, year after year, with a mechanical discipline that most people find boring. And that boredom is the point. Because the moment investing becomes exciting, it has become gambling. There is a deep psychological resistance to this approach. We want to feel smart. We want to feel like we are winning through effort and cunning. We want the story, the tale of how we bought this obscure stock at just the right moment and tripled our money. But the data, decade after decade, study after study, tells us the same uncomfortable truth. The vast majority of active investors underperform the market. The vast majority of people who try to be clever end up being foolish, and the ones who simply stay the course, who invest consistently and resist the urge to tinker, end up wealthier than nearly everyone who tried harder. Being defensive is not about being afraid. It is about being honest. Honest about your limitations, honest about what works, and honest about the fact that the simplest strategy is often the most powerful one. Choose effectiveness over ego. Every time. Chapter 6. The trap of speculation. Let us speak clearly about something that destroys more wealth than recessions, crashes, and bear markets combined. It is speculation. And the danger of speculation is not that it always fails. The danger is that sometimes it succeeds. When you speculate and win, something poisonous happens inside your brain. You begin to believe you are talented. You begin to think you have a feel for the market. You tell yourself that your instinct is sharper than average, that you can see what others miss. And this belief, born from a single lucky outcome, becomes the foundation for increasingly reckless behavior. You take bigger risks. You ignore fundamentals. You chase momentum. And eventually, inevitably, the market corrects your confidence with devastating precision. Graham was meticulous about distinguishing investment from speculation. Investment, he said, is an operation which, upon thorough analysis, promises safety of principal and an adequate return. Everything else is speculation. Everything else. If you are buying a stock because someone on the internet said it was about to explode, you are speculating. If you are buying because the chart shows a pattern you think you recognize, you are speculating. If you are buying because you feel like the price is about to go up, you are speculating. And here is the part that stings. Most people who consider themselves investors are actually speculators who have never been honest with themselves. They carry the identity of an investor, but their behavior tells a different story. Their decisions are driven by emotion, by narrative, by social pressure, by the intoxicating fantasy that they are one trade away from financial freedom. Stop chasing the one great trade. Start building the one great discipline. The intelligent investor does not need excitement. They need consistency. They do not need to be right every time. They need to be positioned in such a way that being wrong does not destroy them. Excitement is the enemy of wealth. Remember that. Chapter 7. The psychology of market cycles. Markets move in cycles. This is not a theory. It is an observable, repeatable, historically consistent reality. Markets rise. Markets fall. They swing between irrational exuberance and irrational despair. And the pattern repeats because human psychology does not change. The intelligent investor does not merely know this intellectually. They internalize it. They build their entire strategy around this truth. They understand that when the market is soaring, when every headline is celebrating new highs, when your neighbor is bragging about returns, that is not a signal to buy more. That is a signal to become cautious. That is a signal that euphoria has replaced reason. And euphoria always precedes a correction. Conversely, when the market is collapsing, when fear dominates every conversation, when pundits are predicting the end of the financial world, that is not a signal to flee. That is a signal to look closely, to examine, to consider whether the assets you believe in are now being offered at a discount by a market that has temporarily lost its mind. This requires a profound psychological reversal. You must learn to feel uncomfortable when everyone else feels comfortable. You must learn to feel calm when everyone else feels terrified. You must train yourself to move against the emotional current, not because contrarianism is inherently right, but because the crowd is driven by emotion, and emotion is the worst compass for financial decisions. Think about the 2008 financial crisis. In the depths of that collapse, when the world felt like it was ending, the S&P 500 was trading at levels that would look like bargains just a few years later. The investors who held their positions, or better yet, bought more at those depressed prices, were rewarded enormously, but most people could not do it. They were too afraid. They sold at the bottom and bought again, only after the recovery was well underway. They sold low and bought high, the exact opposite of what logic demands, and they did it because they were driven by fear, not by analysis. You must decide right now which kind of investor you will be, the kind who follows emotion into disaster, or the kind who follows principle into prosperity. Chapter 8. The value of intrinsic worth. Price is what you pay. Value is what you receive. This distinction, so simple on the surface, is perhaps the most misunderstood concept in all of investing, and the failure to understand it costs people more money than any market crash ever has. Every asset has two numbers associated with it. The first is the price. This is what the market says it is worth today. This number changes constantly, sometimes by the minute, driven by supply and demand, by sentiment, by news, by algorithmic trading, by 1,000 forces that have nothing to do with the actual quality of the underlying business. The second number is the intrinsic value. This is what the asset is actually worth based on its earnings, its assets, its growth potential, its competitive position, its management quality, its financial health. This number does not change every minute. It changes slowly over months and years as the fundamentals of the business evolve. The intelligent investor is obsessed with intrinsic value. They spend their time studying businesses, reading financial statements, analyzing cash flows, understanding competitive advantages. They are not watching ticker symbols flash across a screen. They are reading annual reports. They are thinking deeply about whether a company will still be relevant, still be profitable, still be growing in 10 or 20 years. And here is the crucial discipline. They buy only when the price is meaningfully below the intrinsic value. They do not care what the market thinks. They do not care about momentum or trends or popular opinion. They care about one question and one question only. Am I paying less than this is worth? This requires patience that borders on the extraordinary. It means you will often be sitting on the sidelines while others are making money. It means you will often look foolish in the short term. It means you will pass on dozens of opportunities because they do not meet your standard. But when you do act, when you do buy, you will do so with a conviction that no market noise can shake. Because you have done the work, you know the value, and you know you are right, even if the market temporarily disagrees. Patience is not waiting. Patience is knowing what you are waiting for and refusing to settle for anything less. Chapter 9. Diversification and the humility of uncertainty. There is a particular form of arrogance that destroys portfolios more efficiently than any market crash. It is the belief that you know for certain what will happen next, that you have identified the one stock, the one sector, the one country that will outperform everything else. This arrogance leads to concentration, and concentration, in the world of investing, is a polite word for recklessness. Graham understood that no matter how thorough your analysis, no matter how brilliant your reasoning, the future is uncertain. Companies fail, industries get disrupted, governments change policies, wars break out, pandemics sweep across the globe. Events that no model predicted and no expert anticipated reshape the landscape overnight. And if all of your wealth is concentrated in a single position, a single bet on a single outcome, you are one unpredictable event away from devastation. Diversification is not a compromise. It is not a concession to mediocrity. It is the intelligent response to a universe that refuses to be predicted. By spreading your investments across multiple assets, multiple sectors, multiple geographies, you ensure that no single failure can destroy you. You accept that some of your holdings will underperform, some may even lose money, but the portfolio as a whole will endure. And endurance, as we have established, is the foundation of wealth. Think of diversification as an act of humility. You are saying, I am smart enough to invest, but I am not arrogant enough to believe I know exactly what will happen. This is not weakness. This is the highest form of financial maturity. And it is the hallmark of every investor who has survived long enough to compound their wealth across decades. The person who puts everything into one basket is not courageous. They are simply unaware of how much they do not know. Chapter 10. The Compounding Quiet. There is a force in investing that is so powerful, so relentless, so mathematically unstoppable, that Einstein allegedly called it the eighth wonder of the world. Whether he said those exact words or not is irrelevant. The truth behind them is irrefutable. That force is compounding. And the secret of compounding is not intelligence. It is time. $1,000 invested at a 10% annual return becomes over $17,000 in 30 years. Not through genius, not through effort, simply through time, through the patient, quiet accumulation of returns upon returns upon returns. Each year your money earns more, because each year there is more money earning. The snowball grows, slowly at first, imperceptibly, and then, after years of what feels like nothing, exponentially. But here is the tragedy. Almost no one lets compounding do its work. They interrupt it. They withdraw too early. They panic and sell during a downturn, resetting the clock. They get bored and move their money into something sexier, sacrificing the quiet accumulation for the thrill of novelty. They do not realize that every time they disrupt the compounding process, they are not just losing the money they moved. They are losing all the future returns that money would have generated, and all the returns on those returns, stretching out into decades, they will never reclaim. The wealthiest investors in history are not the ones who made the most brilliant trades. They are the ones who started early and never stopped. They are the ones who let time do what time does when you do not interfere. They are the ones who understood that compounding rewards patience with an almost spiritual generosity, but punishes interruption with permanent loss. Start now. Not tomorrow, not when you have more money, not when the market looks right, now. Because every day you delay is a day of compounding you will never get back. And the quiet days, the boring days, the days when nothing seems to be happening, those are the days your wealth is being built. Compounding does not shout, it whispers, and those who listen become wealthy. Chapter 11. The danger of following the crowd. There is a psychological phenomenon so deeply embedded in human nature that almost no one is immune to it. It is the instinct to follow the group, to do what others are doing, to assume that if everyone is buying, there must be a reason. If everyone is selling, there must be danger. This instinct kept your ancestors alive on the savannah. In the financial markets, it will destroy you. When the crowd is buying, prices are rising not because value is increasing, but because demand is increasing. And demand driven by imitation, rather than analysis, creates bubbles. Bubbles in tech stocks, bubbles in real estate, bubbles in cryptocurrency, bubbles in anything that captures the collective imagination long enough to detach price from reality. And when the bubble bursts, and it always bursts, the crowd reverses. The same people who were euphoric last month are now terrified. They sell into the decline, accelerating the collapse, locking in losses that a more disciplined investor would simply ride through. The herd runs in both directions, and both directions at the extremes are wrong. Graham observed this pattern with the detachment of a scientist studying a predictable experiment. He saw it happen in the 1920s. He saw it happen again and again throughout his career. And the lesson he drew was simple, but demanding. The intelligent investor must be willing to stand alone. They must be willing to hold a position that the crowd has abandoned. They must be willing to avoid a trend that the crowd has embraced. They must derive their confidence not from consensus, but from analysis. This is psychologically difficult in ways that most people underestimate. Humans are wired for belonging. Disagreeing with the group feels dangerous. It activates the same neural circuits that once warned us about exile from the tribe, which in primitive times meant death. To stand apart in your financial decisions is to fight millions of years of evolutionary programming. And yet that is exactly what the intelligent investor must do. You do not need the crowd's approval. You need the crowd's mistakes. Chapter 12. The relationship between fear and opportunity. Fear is the most expensive emotion a human being can carry into the financial markets. It costs more than ignorance, more than greed, more than overconfidence. Because fear causes you to do the one thing that guarantees loss. It causes you to sell at the worst possible moment. But fear is also the intelligent investor's greatest ally. Not their own fear, other people's fear. When the masses are terrified, when headlines scream disaster, when portfolios are bleeding red across every screen, that is when the intelligent investor begins to look closely. Because fear creates mispricing. It forces sellers to dump assets below their intrinsic value. It creates the very discounts that the margin of safety principle demands. This is counterintuitive in the deepest sense. Every fiber of your being will tell you to run when others are running, to protect what you have, to retreat to cash and wait for the storm to pass. And that instinct, though understandable, is the instinct of the speculator. The intelligent investor does not flee from fear. They walk toward it, carefully, analytically, with the calm of someone who is prepared for this moment precisely because they knew it would come. Think of market crashes not as disasters, but as sales. The same stocks you wanted to buy last year are now available at a 30, 40, or 50% discount. The underlying businesses have not changed. Their products are still in demand. Their customers are still there. Their cash flows are still real. The only thing that has changed is the mood of Mr. Market. And mood, as we have learned, is not a reliable measure of value. Fear will always be present in the market. The question is whether it controls you or whether you use it. Chapter 13. The long game nobody wants to play. Here is the truth that no one wants to hear. Building real, enduring wealth is boring. It is not dramatic. It is not cinematic. There is no montage, no moment of sudden revelation, no single trade that changes everything. It is a long, quiet process of consistent decisions repeated over decades. And this is precisely why so few people achieve it. We live in a culture addicted to speed, to instant results, to overnight transformations. We want the shortcut, the hack, the one weird trick that Wall Street does not want you to know. And this craving for speed is exploited by an entire industry of financial entertainers who sell the fantasy of quick riches to people desperate enough to believe it. But Graham's message, the core of everything he taught, was the opposite. It was slow. It was methodical. It was grounded in the unsexy discipline of reading financial statements, calculating intrinsic values, maintaining diversified portfolios, and waiting. Waiting years, waiting decades, waiting with the quiet confidence of someone who understands that time is the most powerful force in investing and that patience is the only way to harness it. The investors who become wealthy are not the ones who found the secret. They are the ones who kept going when there was no excitement, when the portfolio barely moved, when the market was flat for months, when friends were bragging about speculative gains. They kept contributing, they kept holding, they kept trusting the process, and 10 years later, 20 years later, 30 years later, they looked up and realized they had built something extraordinary, not because they were brilliant, because they were relentless. You must decide if you have the psychological architecture for the long game, not the desire. Everyone desires wealth. The question is whether you have the temperament to endure the years of silence between planting the seed and harvesting the fruit. The long game does not reward the gifted, it rewards the unbreakable. Chapter 14. Becoming the investor you were meant to be. By now, if you have truly listened, if you have allowed these ideas to penetrate rather than simply pass through, something inside you has shifted. You are no longer the same person who pressed play at the beginning of this audiobook. You have confronted truths about yourself that most people spend their entire lives avoiding. You have stared at your impulses, your fears, your need for excitement, your addiction to action, and you have seen them for what they are. Obstacles, not to the market, to yourself. The intelligent investor is not a persona you adopt. It is not a role you play when you open your brokerage app. It is an identity, a way of being. It is the calm in your voice when someone asks you about the latest market crash. It is the clarity in your mind when headlines are designed to provoke panic. It is the discipline in your hands when they want to reach for the sell button, but you keep them still. This identity does not form overnight. It is forged through repeated decisions. Every time you choose not to react, you strengthen it. Every time you choose analysis over emotion, you reinforce it. Every time you choose patience over impulse, you deepen it. And over time, these accumulated choices create something unshakable, a psychological foundation upon which not just your wealth, but your entire life can be built. Graham did not just teach investing, he taught a way of thinking, a way of evaluating, a way of moving through a world designed to provoke you into poor decisions. And the principles he laid down more than 70 years ago remain as true today as the day he wrote them. Because the market has changed, technology has changed, but human psychology has not changed. And it is human psychology, not market mechanics, that determines whether you win or lose. You now have the blueprint, not for a trading strategy, for an identity transformation. Chapter 15. The Quiet Certainty. You have reached the end, but this is not really an ending. It is the beginning of a practice that will span the rest of your life. Because the intelligent investor is not something you become once. It is something you become every day, every decision, every moment of restraint, every act of patience, every refusal to be moved by noise. Each one is a brick in the structure of the person you are building. The world will continue to be loud. Markets will rise and fall. People will chase and panic and chase again. New trends will emerge. New gurus will promise what no one can deliver. And through all of it, you will sit with a quiet certainty that does not need to announce itself. You will know what you own and why you own it. You will know what you are waiting for and why you are waiting. You will know that the greatest returns in investing do not come from brilliance or speed. They come from the disciplined refusal to abandon a sound strategy in the face of temporary discomfort. Benjamin Graham did not leave behind a system for getting rich quickly. He left behind a system for getting rich permanently, for building wealth that lasts, wealth that survives crashes and bubbles and the endless noise of a world that profits from your confusion. His principles are not exciting, they are not fashionable, they are simply true, and truth, unlike trends, does not expire. You are not the person you were when you started listening. You are calmer, you are clearer, you are more dangerous. Not dangerous in the way the market fears, with reckless bets and overconfident predictions. Dangerous in the way the market respects, with unshakable patience, iron discipline, and the quiet certainty that comes from knowing you have built your financial life on a foundation that does not crack. Go now, not with excitement, not with urgency, with the steady, composed authority of someone who has stopped chasing wealth and started becoming the kind of person wealth cannot leave. The blueprint is inside you. The only thing left is time. And time, for the intelligent investor, is not a burden. It is the greatest gift of all.